You wake up, check your portfolio, and freeze. Overnight, 30% of your net worth is gone. No warning bells, no breaking news alerts, just a sea of red numbers staring back at you. The immediate reaction is to look for an excuse. Investors point to black swan events or a sudden lightning strike in the global economy. They call it unavoidable bad luck. But financial wipeouts rarely drop out of a clear blue sky. They are preceded by loud, observable indicators that the market collectively decides to ignore. A 30% drop requires a 43% gain just to break even. By the time that loss hits your screen, years of financial progress have already vaporized. History runs on a loop of collective amnesia. At the turn of the millennium, tech valuations defied gravity right up until the dot-com bubble popped and gutted a generation of portfolios. 8 years later, the 2008 financial crisis repeated the pattern. After the 2020 pandemic crash, we saw the wildest rebound in modern history. By 2021, new retail investors, supported by stimulus checks and easy capital, treated the stock market like a casino that only paid out. Fast forward to today, indices hover near historic highs. The VIX fear gauge has flatlined. The market is comfortable. That comfort is the most precarious phase of the cycle. It is the exact moment where everyday traders mistake the momentum of a lucky bull run for their own financial genius. Economist Hyman Minsky discovered a brutal paradox in how markets function. He observed that prolonged periods of economic stability inevitably manufacture explosive instability. When stock prices march upward for years without a correction, investors get bored with safe returns. To keep the momentum going, they begin stretching for yield, taking on increasingly irrational risks. Think of the market like a tower of wooden blocks. At the start of a cycle, the base is wide and secure. But as confidence grows, investors pull blocks from the base to stack them higher. The tower reaches record heights, but the base becomes dangerously narrow. From the distance, the height looks impressive, but as leverage peaks, the structure begins visibly swaying. The system becomes hyper-fragile. This is why massive corrections catch the public off guard. Markets don't collapse because people are terrified. They break because everyone feels invincible and stops checking the structural integrity. The indicators of that fragility are already present. Extreme complacency has pushed stock prices to historically unjustified levels, where price-to-earnings ratios have completely detached from company earnings. This chart shows margin debt levels tracking alongside major stock indices. Millions of traders are borrowing massive amounts of capital from their brokers to buy more stock, pouring fuel into an already overheating engine. Beneath the green tickers, foundational health metrics are shifting. Indicators like inverted yield curves and slowing manufacturing output are signaling a contraction, even as the broader market chooses to look the other way. Gravity is setting in through sustained high interest rates. When the cost of borrowing capital stays elevated, it creates a drag on corporate balance sheets, making existing debt nearly impossible to service. Because these factors haven't triggered an immediate meltdown, many investors believe the old rules no longer apply. They leave their capital fully exposed, assuming the stability will last forever. Eventually, the over-leveraged system buckles. It could be a liquidity freeze, a string of catastrophic earnings reports, or a geopolitical shock. The specific trigger is secondary to the fact that the market has reached its breaking point. Building wealth takes decades of discipline, but wiping it out takes days. When margin calls hit, brokers are forced into massive, rapid liquidations to cover borrowed debt. The resulting downward spiral is violent and unforgiving. When trillions of dollars evaporate, the damage moves from trading screens into the real world. It translates to frozen credit markets, mass layoffs, and the disruption of millions of lives. Surviving a major crash is not a matter of luck. It is about maintaining situational awareness and securing your positions before the panic selling begins. Warren Buffett operates on a reliable principle: be fearful when others are greedy, and greedy when others are fearful. Take a hard look at your own portfolio. Consider whether you are positioned for long-term survival, or if you are ignoring the environment just to chase a few final points of profit. If the foundational blocks give way and the market crashes tomorrow morning, what is your exact first move?